Hey everyone, this is Derek here from the Dividend Talk podcast. Today we have Bob Lay from talkon.com talking to us about his journey as a dividend growth investor from a Canadian perspective. The podcast itself is around 2 hours long, and I didn't want to put that all together on YouTube because it's probably too long for a lot of people. So what I've done is I've taken snippets out and posted it instead. This part of the discussion is around Bob's idea around whether you should own high yield and low dividend growth stocks versus low yielding high dividend growth stocks. Let us know your thoughts below. See you on the inside. I'm interested to hear your thoughts on the low yield, high growth question.
Yeah, so I did write a post about it. I think it was early last year, and I'm a spreadsheet guy, so I did some scenario analysis, and the reason I said it depends on where you are on your journey. If you're closer to retirement or you're already retired and you really need the income, then you're probably more focused on the higher yield or growth because you need the income, right? Now, if you're in your early 20s or 30s and you have, 20, 30 years ahead of you in terms of this investing journey, you could afford to invest in some lower yield, high growth, high dividend growth stocks, right? Because the growth will take over eventually. So what if it's like 1% or 0.5%? If the dividend payout is increasing by 20, 30% a year, there's going to be a cross point to the higher yield eventually, right? So it really depends on where you are in terms of journey. Now, for us, our goal is to live off dividends. We kind of set a target of 2025, but to be honest, at this point, we're getting pretty close to that if we supplement it with some part-time income. So for us, we're probably more looking at the higher yield aspect, but still paying close attention on the low yield, high dividend payout stocks. Hope that makes sense.
Yeah, no, it makes perfect sense. I kind of agree with you. When you say high yield, what kind of yields would you class as high yield? What's a high yielding stock?
Well, like Canadian market, if you look at it, you could get 4% yields pretty easily. If you look at the US market, 4% is pretty hard to find, right? The US market is usually about 2%. Canadian market, like look at all the Canadian banks, they're yielding roughly about 4% right now, right? So if you're in Canada, high yield, I would say like 6 and up. Now, some people may fall into the trap of, hey, I want as high yield as possible, get like 10% and stuff, and then you get into these like cover call ETFs or split corp where you're getting 10, 15, 20% yield. That's where it gets really, really dangerous. I almost sort of, my analogy to those high yield, like those cover call ETFs and mostly on those split corp, is it's almost like a Ponzi scheme, right? You're just getting your money back. You're not actually growing your money. So when somebody says, hey, I my portfolio yielding 15%, I'm getting, I invested 200,000, I'm getting $10,000 a month. It's like, whoa, hold on a second. Like, do you know the risk involved here? Right. So it's you have to look at it from a risk and reward point of view as well.
The issue that I have with, let's say, 1% yielders or 1.5% yielders is that you end up forecasting, let's say, 15 to 20% growth over the next decade. And this is kind of finding this 100 bagger, right? Which is like one out of the whole entire S&P 500 that might be able to do that on a 10-year lifespan.
Exactly. So you probably, it also depends on, again, it comes back to your timeline, right? So if you may allocate only 10% of your portfolio to these low yield stocks or bigger percentage if you're younger. But I would argue if you're younger, you're probably better off investing in an index or equity fund, right? Which you capture the market and then hence select the individual dividend stocks as you see fit.
Yeah. And the question that we often get, and maybe it's already a nice question to ask, like, for instance, I've got Microsoft, right? I bought Microsoft at in the $40 range for the first time. So I probably have like a 4 or 5% yield on cost, but and I think I bought it even at a 3% yield or something like that. And now it's of course like, was it 1 point something? I often get the question like, hey, why don't you sell it and replace it for a higher yielding? Yeah. So what is your philosophy around this one? If you have at companies that just like went up 4 or 5 times in price, more because of multiple expansion and such, do you keep them and let your winners run, or do you sometimes roam it off and replace it with higher dividend income stocks?
I think it depends on whether you believe in the company or not, right? Like in terms of Microsoft, I think the growth is still there and it will continue to raise dividends, right? For example, we got in Apple very, very early, and where cost on yield is pretty high. I think right now it's like 0.6% yield, but ours is like multiples of those, right? And we kept Apple because we think it'll continue to grow. And I think the danger with dividend income investing is you can't just look at the dividend aspect only. I know some dividend investors say, oh, they only care about dividend income if they're getting $50,000 a year. They don't care if their principal goes down or not, right?
Yeah.
I'm more on the side of I want my dividend income and I want my principal to grow, right? Because if my dividend income is not enough, at least I could sell some principal, right? So when your principal is not growing, you can't. It's harder to sell, right? It's harder to use your principal to supplement your dividend income. So I would say, yeah, in Microsoft point of view, if we have Microsoft, I would just keep it, right? Generally speaking, when we invest in a stock, we tend to hold it forever. At least that's our plan. Obviously, plans change, but for the most part, I don't think it makes sense to switch back and forth between these stocks just because the yield is higher.
Yeah, so I follow the same approach. I just learned to let my winners run, because I once made the stupid mistake to sell McDonald's. I got it at $90, and I thought at $120, oh, it's already overvalued. It was really early in my dividend investing career, let's say. And I just learned, like, it makes no sense to look at it with such a lens. To your point, if the business is thriving and it's growing, then whether it's overvalued, it's actually not really it's a luxury problem, right? The most important is, can the dividend grow and continue to grow? And so I'm like stocks like Microsoft and Apple that went like 4 or 5-fold for me. I'm just keeping them, and I really enjoy that. I see, like, let's say the initial dividends, how they look like at the time of investing, that they doubled in those few years, right? And it also is kind of, for me, always a nice proof of that dividend growth investing. And I think that's the point you're making, with the emphasis also on growth, is actually really bringing in the compounding. The worst I could do is sell it for kind of such a stock that I regret later selling for a dividend cut or something like that.
Exactly.